Hey, it's me here with a thought. Europe's banking system is too fragmented. We should break it up. Now, I don't mean blow up the euro or anything quite so drastic, but the European banking system is still held together with duct tape and good intentions, and that doesn't work anymore. So let me explain. The EU's financial markets are still hampered by capital and liquidity trapped behind national borders. About 225 billion euros in capital and 250 billion euros in liquidity. That's according to the Financial Times, which has been doing great work on this topic. And that figure represents about 6% of eurozone banks' total assets. And that's just the tip of the iceberg because cross-border banking mergers take an average of 285 days to approve. That's far slower than the US at 219 days and the UK at 173 days. And those delays hamper Europe's international competitiveness. And here's the other problem. Retail banking is still largely national. A 2021 study by the European Systemic Risk Board found that 94% of payment transactions within the euro area were conducted within the same country. Now that means consumers cut and take their business to another EU country where they might get better service or lower prices. And that lack of competition means that European banks are slower to innovate, and that holds back Europe's economic growth. Now, there have been some notable cross-border deals recently. BBVA sold its Luxembourg arm to rival Spanish bank Sabadell, and Deutsche Bank bought a smaller rival in the all-important and fast-growing wealth management sector. But these are the exceptions that prove the rule. Most banks still shy away from the complexity of operating in other EU countries. Now the big question is why? And the answer is mostly legal and regulatory barriers. 27 EU countries have different laws and regulations for setting up and running a bank. There are also differing insolvency regimes, different deposit guarantee schemes, and different supervisors. That creates uncertainty and it adds to the cost. It also means banks need to hold more capital, which means less lending and higher prices for consumers. Now, over the past decade, the European Union has made progress reducing these barriers. It set up a single supervisory mechanism for banks in the eurozone, and it created a resolution college to wind up failing banks in a coordinated way. But progress has been slow and painful. One reason is that national governments are reluctant to give up control of their banks. They see them as too important to fail and also as a source of cheap funding. Well, that's not always true. Another reason is that EU rules are often drafted with the interests of big banks in mind rather than smaller ones. And that makes it harder for small, innovative banks to challenge the status quo. Now, some smaller countries also worry that they won't get a fair share of resources if there's a big banking crisis again. So they want to keep their banks at home where they can protect them. But these arguments don't hold up anymore. First, countries like Ireland and Spain proved during the eurozone crisis that even with strict EU rules, they could still bail out their banks. Second, customers shouldn't be hostages to national crises. It's not fair on them. And third, smaller banks can use technology to compete with bigger ones. Take N26, a German digital bank. It now operates across the eurozone and it has more than 7 million customers. So we need reform and we need it fast. What kind of reform? Well, we need to make it easier for banks to obtain a license to operate across the EU. We also need to recognize that banks have different risks and different business models, and we need to treat them accordingly. And we need to give smaller banks a better deal. Otherwise, they'll never grow up to become European champions. So breaking up the banking system is easy to say, but it's much harder to do. It requires political will and coordination, lots of it. And that's in short supply right now. You may also need treaty change, which is almost impossible these days. The EU has form on this. Treaty change was needed to create the euro and to create the banking union. But once the pandemic emergency is over, politicians will revert to type and focus on narrow national interests. That's one reason why the European project has failed to deliver on its promise. The other is vested interests. National governments and big banks benefit from the status quo. Breaking it up would mean starting again from scratch, and that would be painful. So who's going to lead the charge? Well, France is surprisingly keen on closer banking integration. Germany is more lukewarm. It prefers working with national champions like Deutsche Bank and its retail arm, Postbank, and smaller countries like Ireland are happy to go along with whatever the big boys agree. So the next time you're in a French or German bank wondering why it's so expensive, you'll know what to blame. And the funny thing is, those high prices could end up making the whole euro project uncompetitive, and that would be the real tragedy. Thanks for watching. If you haven't seen it yet, you really should watch our recent video on China's new national security law. It's spooking investors and it could derail Hong Kong's recovery. Thanks again. See you soon.